right, so let's talk. We have our income and expenses. Just and we can talk
Okay.
about these all day, but to move this forward, we have income, we have expenses. What do we do next? Like for someone who hasn't gone through the actual algebra and the calculations here, walk us through an example here. We have income of 100K. Expenses are 40,000. This is before any debt. Well,
Right.
walk us through here.
So what you want to factor in, and this we can start talking about how we value and get to a number here. You have basically your income, subtract your expenses, and you get your net operating income, your NOI. That's going to be something that you're going to hear a lot of. Most of you are aware of that. And your before you even get to NOI, if you just look at your gross income, a lot of people will use what's called a GRM to value a property. And I don't know why this is so common in Chicago. And when I started, everybody just used the gross rent multiple. I'm going to figure out, okay, I'm grossing $100,000 on this six flat. Okay, I'm going to look at comps. And obviously, I know the comps in North Side, let's say 10 times gross is roughly what a building is trading for. 10 times $100,000, you have $1 million building. That's the value. That's what I'm going to pay for it. That's how some guys do it. And other people will want to take it a step further and say, well, I can be a little bit more specific in valuing a property, and I want to use cap rate. So cap rate takes your net operating income, right? So you take that $100,000 minus your $40,000 of expenses, you've got $60,000 in net operating income, divide that by your total purchase price, and that will give you your cap rate. And so on this example, if it's $60,000 and I want to pay $1 million for the building, that's a six cap, 6%. That's great. And for a lot of properties for many years on the North Side, a six cap and a 10 times gross made sense. And people would buy buildings at that price.
Yep. But now why that? Tell us why that may no longer make sense.
So, and this is something that I think we were talking about a couple of months ago. For anybody who's been living under a rock, you may not know that the interest rates have climbed quite a bit in the last 6 to 9 months, where deals that we were doing in the first half of 2022, you could get an interest rate of 4%. And this is where I wish I had my computer still alive, but at 4% interest, a six cap looks very different than a six cap at 6% interest, which is where we're at now at the end of November. And so basically what we're doing there is a lender is going to look at the debt service, and they're going to say, hey, if we're at this interest rate of 6%, it's going to cost you, and I think I put the numbers in that outline, but maybe like $54,000 on $1 million building. If you're putting
so
down,
here, I'll just share because I do have it pulled up here.
yes.
So you buy $1 million building. The examples we have was, 100 grand of gross rent.
Mm-hmm.
We had 40 grand of expenses. So you had, 60 grand left over before debt at a 4% rate at 25% down. The debt service would be 43 grand for the year. Okay. And so that leaves you roughly, call that what, 17 grand, right? Did I do that right? 100 minus 40 is 60, 60 minus 43. You have about 17 grand of cash flow for the year, which 17 grand over that 250 grand you put in, that was your down payment, was a cash on cash of 6.8%. And then if you do principal pay down as well, it's a total return of about 12%, which in a nice North Side neighborhood, I think most people feel pretty decent about that.
Right. Depending on, again, this doesn't look at any of the capital improvements you might have to make a building. We're assuming that
Correct.
Building's in good shape. You don't have to put money into it right away. I think that's been generally the market. And I think that a lot of my clients, when they're looking at properties, yes, cap rate's very important, but ultimately it's important because of how much money you're going to make on it. Right. And so at a 4% interest rate, what was it? It was 6.8%. Is that what you said?
Correct.
6.8% return on cash. That's not too bad. And back in July, especially what was your alternative, right? If you put your money into a CD or just a, interest-bearing savings account, you're making nothing, right? Now I think that's bumped up, and you can make over 4% in just a CD, right? And so maybe 6.8% isn't as attractive right now. You might need a higher return. But let's look at the difference. And so if I'm buying the same building at $1 million, same cap rate, same GRM, right? It's a 10 GRM, $1 million. It's a 6 cap, but it's going to cost me a lot more to get that same loan.
Yeah.
Because
so just to pull, because I have it pulled up, you had 100 grand gross rent, you had 40 grand of expenses. So you're at 60K. The debt service now climbs all the way up to 54 grand. So two things happen here. Your cash flow goes from 17 grand to 6, but not only that, you don't have debt service coverage ratio now. So you can't get a loan at 75% loan to value. So now you need to put more money down and you're getting less return. So your cash on cash metric, you now have a bigger denominator, right? You have to put more money down to get the same deal and you're getting less of a return on it. So you get squeezed both ways and it kills you.
Right. So it's harder to get that equity available. And then you're not going to for even the same return, but now your return is just crushed and your cash on cash and your total return. So in that example, that same $1 million building, what was the cash on cash? It was like 2%, if I remember correctly.
Yeah, we're just over 3, but it basically gets cut in half just from the rate jumping from 4% to 6%. All other variables equal.
Right. You got to put 34% down. That's a huge outlay of cash in addition to that. Like that's opportunity cost for that additional money.
$90,000 that you are no longer have access to. So yeah, that's a huge deal. And so, when people use, and that's why I always say, like, yeah, I can use cap rate. Cap rate's really important. It's a great indicator of value. But if you're not factoring in the debt market, unless you're paying for everything in cash, which I don't think I've had anybody actually do in the 6 years I've been doing this, it doesn't matter. It's really your cash on cash return and your total return that you're going to get.
Your cash on cash is, like, especially for most of our listeners, is like the most important metric because that's telling you exactly what you're putting into it. The cap rate is really irrelevant to your personal growth of your wealth. That you opportunity costs definitely, but that cash on cash is what it's doing for you because the whole BRRRR strategy is huge for that reason, that you're only leaving 0 to 10% into a BRRRR deal because your cash to cash high. Even if you only make a couple $100 a month, you're getting all these other benefits of owning a piece of real estate and not having to have any cash out of your pocket. So cash on, I just think it's huge. And I think it gets overlooked when the word cap rate gets thrown around because I think people think it's fancier.
Right. And people love using cap rate. People love using GRM, which I think is even less useful than cap rate.
GRM, so a lot of our listeners are familiar with, like, the 1% rule. It used to be 2% rule. Like, it's similar concept, just in a different way of calculating it, correct?
Yeah. It's the 1% and 2% rule. And forgive me, I haven't heard those in a long time. It's something about, like, the
1% of the rent of the purchase price. So a 10% GRM would be equal to a 1% rule, correct?
It's crazy. It doesn't account for expenses, boiler building or not. It doesn't account for that $800 a month line item expense. Doesn't account for how the taxes are.
So you can't tell how good of a deal the guy that's got his individual furnaces versus the guy that has a boiler, like separation of which one's more attractive.
Right. And so the GRM is great, but when you factor that in, you just have to know the type of building. And you brought it up. Like, if it's a boiler building, the GRM is going to be it's going to be the same as an HVAC building, but your expenses are going to be much higher. So, I would need a lower GRM to buy that boiler building.